Hi, it's Econ time. In this video, we are going to study Chapter 7, Part 1. The first one is growth trend. Growth trend is the expansion or contraction of an economy over a very long period of time. How long is long? Usually longer than 50 years. 100 years is long, 200 years is long, even 500 years, 1,000 years, that is long. So the tendency of the growth is the growth trend. The second concept we have is business cycle. Business cycle is the fluctuation of real GDP in the short run. How short is short? Usually within 10 years. 5 years is short, or sometimes it's within 1 or 2 years. So real GDP do not always grow at the same rate. It fluctuates. So those fluctuation is called business cycle. So next, we want to see how the economy grow around the world. When we try to do that, we want to use real GDP per capita to track the standard of living. Real GDP per capita means GDP per person. So the reason is because it tells the average amount of goods and services a person can consume. Okay, so let's take a look at this chart. First of all, let's take a look at the green line down there, which says the world average. You can see that this chart starts from 1870 to now. So before 1940, the world grow, but it's in a more flat pattern. But after 1940, the whole world grow a little bit faster. You can see that the curve turn a little bit upward. So that is the world average. Now let's take a look at the United States. And you can see the chart over here. Before 1940, our growth is faster than the world average. But after 1940, after World War II, you can see that our growth actually is faster than the growth rate before 1940 because the curve, the slope of the curve becomes steeper. So that's point number one. Point number two is our growth is not smooth. You can see these little ups and downs along our growth. Those little ups and downs is the business cycle. So that is for the United States. You can also see United Kingdom. In the beginning of this chart, 1870, you can tell that United Kingdom has a higher GDP per capita. You all know that GDP is income, GDI is income. So it means that their GDP per person, their income per person is higher than the United States. But then very soon the United States catch up, and then after 1940, you can see that US grows faster, United Kingdom also grow, but it's not as fast as the United States. So you can see that at the end of the chart, the two countries has a bigger and bigger gap over there. So that is United Kingdom. And then if you take a look at Mexico, Mexico is the red line. You can tell that back in 1870, Mexico's income per person is below the world average. But then you can tell that it becomes higher than the world average. So it grows faster until 1980. and then the growth rate start going down a little bit, so it's still above the world average. So that is Mexico. And then you can see Japan. Japan in 1870 is also below the world average. It is almost the same income per person with the Mexico. And then after World War II, started from 1950, Japan in fact pick up their growth speed. So they grow really fast. You can see that at first the gap between the United States and Japan becomes narrower and narrower. This growth trend lasts until 1990 or so. Ever since 1990, Japan experiencing a few recessions, and then their growth actually slows down. So by the end of the chart, you can see that Japan now is below the United Kingdom. So that is Japan's growth trend. Among those countries that we just see, which country do you think is the best performer? Do you think the United States? Yeah, I agree with you. How about the most improved? Which country? Do you say Japan? Yeah, I agree with you. I got those data from this link. So if you want to see the other countries' growth, you can go to their website and take a look. I select only a few of this country to illustrate the concept of growth trend and business cycle. The chart that I just showed you is using real GDP per capita. So how do we calculate those growth rate? So here is one example. If there are 2 years figure that is given to us, 2013 was 4,000, 2014 is 3,800. What is the growth rate? So when you calculate the growth rate, you use the percent change formula. That is, you use 2014's 38,000 and then minus the previous year's GDP per capita, which is 4,000, divided by 4,000. And then after that, you multiply by 100%. So the answer is negative 5%, meaning that this economy get into a recession because their real GDP goes down. When it goes to about the growth, rule of 70 is a very straightforward calculation that you can use to find out how long does it take for a variable to double. So 70 is a constant. You divide that by the annual growth rate. So here is one example. There are two countries, A and B. Both at current is having $10,000 per person as their real GDP. So if country A has 2% growth, country B has 3% growth, will it make a significant difference in the long run? So at the first look, the difference between the two countries is only 1%. So is it really makes a huge difference by the end? So let's take a look. First of all, we use the rule of 70. For country A, the year to double their GDP is 70 divided by 2. So remember 2%, drop the percent, only use 2, okay? So you got 35. This means it takes country A 35 years to double their GDP. For country B, it's going to be 70 divided by 3. and that would be 23.33 years to double their GDP. All right, so for country A, the first double their GDP from 10,000 to 20,000. So that takes them 35 years to do the first double. And then the second double is double from 20,000 to 40,000. So this time it will take an additional 35 years to do that double, right? So the first is 35 years and then you plus another 35 years. It means that in total it takes them 70 years to reach GDP up to 40,000. And then the third double is you double 40,000 to 80,000. So this time we need to add another 35 years on top of 70 to get 105 years to reach 80,000. So this is for country A. For country B, it takes them 23.33 years to have the first double. And then you add another 23.33 years. Now it's 46.66 years to do the second double. And then you add 23.33 to 46.66. That is about 70 years. So it takes them 70 years to reach their GDP up to 80,000. So let's see what is the difference between the two countries. So they start at exactly the same GDP per person. And then after 70 years, A's GDP per capita reaches 40,000. While for B, after 70 years, their GDP per capita becomes 80,000. It is double the size of country A. Therefore, in conclusion, even though there is 1% growth rate difference, but in the long run, it plays a very significant role. What we learn from this example is that the economic growth rate plays a very important role on GDP per person in the long run. So because of that, we would like to know what is the cause of the long-run economic growth. The answer is simple. It is labor productivity. Do you remember we have studied labor productivity back in chapter 2? Labor productivity is the amount of output produced per labor hour. So if two countries have the same amount of resources, but for country A, their worker can produce more goods and services out of the same resources than country B, then country A is going to have more GDP per person. So that is why labor productivity determines economic growth. So we found that there are three major determinants of labor productivity. Let's see what are they. The first one is physical capital. It is a man-made productive asset, including machineries, equipment, and constructions. If you feel like this concept is familiar, you're right. When we talk about what is in resources, resources are land, labor, capital. That capital and this capital is the same. So if workers are well equipped with equipments, machineries, and constructions, then they can produce more goods and services. The second determinant is human capital. It is knowledge and skill workers acquire through education, training, and experience. So right now, you're watching this video, so you are an investor. You are investing to accumulate your human capital because you will acquire knowledge, and then you will become more capable to produce goods and services in the future. So good job. The third one is technology. Technology is the mean to produce goods and services. It is knowing how to produce goods and services in a more efficient way. So that is technology. So you can see that all these three are the determinant of labor productivity.